Hello, everybody. This is Remco Fischer here from the UNEP-FI Secretariat. Thank you for joining this UNEP-FI webinar. I hope everybody can hear me now. If you have difficulties in hearing me or the subsequent panelists, please let us know using the chat function of the webinar environment. Welcome to this webinar on the issue of measuring, disclosing, and managing the carbon and climate risk in portfolio investment. My name is Remco Fischer, and before I pass on the word to Nick Robbins, who is the moderator of the session, just a few housekeeping rules. Firstly, the webinar will run for an hour, and we now have, just checking, over 70 participants, so we're very pleased with this great level of participation. Second important thing for you to note is that you are muted. You cannot speak with us. And you will remain muted for the entirety of the webinar. However, this is interactive. You are encouraged to pose questions, to make comments, and those questions will be integrated by Nick as the moderator in the Q&A session of the webinar at the end of it. So please feel free to make use of the chat function. Also to let you know that we're recording this webinar and that we will be posting the recordings as well as the slides that people are using on the UNEP-FI website under unepfi.org. And so feel free to look up the website once or share the link with your colleagues and within your networks. The format of this is very simple. We'll have an introductory presentation, initial statements from our panelists, a moderated discussion with your questions, and then we will close the webinar. That's all from my side. Without any further ado, I'll pass the word to Nick Robbins, who is the moderator of this webinar. And from the UNEP-FI Secretariat here, we just hope that you find this 1 hour to be very interesting and useful. Thank you very much. And Nick, over to you.
Thank you very much, Remco, and thanks to everyone for joining this webinar. Remco, if you want to move to slide 2. So my name is Nick Robbins, head of the Climate Change Centre at HSBC, and I'll be moderating and providing a little bit of a background in terms of this issue of measuring and disclosing carbon intensity and risks. Will then be followed by Nigel Topping, who is the Chief Innovation Officer on the Carbon Disclosure Project. We look at their experience and lessons learned. Dr. Julie Gorte, Senior Vice President of Paxworld, will then come after Nigel, really looking at the agenda from an asset manager perspective. Following Julie, we have Julian Poulter from the Asset Owner Disclosure Project, a new civil society initiative focusing on disclosure from the financial sector. And to wrap us up, we'll have Bill Hartnett, the Sustainability Manager of the Local Government Superannuation Scheme in Australia, again giving a perspective from an asset owner. So some context from me, some perspectives from both the asset manager side and asset owner side, and then from the CDP and AODP in terms of this evolving agenda of investor risk assessment and disclosure. So if we move to slide number 3, Remco, please. So why have we really hosted this investor briefing today? This is a project that has been underway for a number of years at the UNEP Finance Initiative, bringing together the Climate Change Action Group and also the Investment Commission. And what we'd like to do today is really refresh with you the rationale for why investors need to manage greenhouse gas emissions associated with their investments, to really initiate a discussion with you about how we can measure and disclose the profile of their investments, and then to explore some of the current quantitative and qualitative approaches for doing this. There have been a number of members of UNEP-FI which have contributed to this briefing, as well as partners such as the Carbon Disclosure Project, and their logos are on the slide for you to see. So if I can, my presentation will really look at sort of 2 real aspects, sort of why we believe that this issue is becoming more important, how investors have been doing it, and really what next for investors. So in terms of the why issue, I'll briefly go up sort of five real issues. One is the public policy dimension. Secondly is the climate impacts, obviously, which has been prominent this year around the world. Third, the linkage from carbon performance and business performance. Fourth, the growing expectations of investor transparency around the world. And fifth, the regulatory drive from the policy community in terms of mandatory reporting. So let's maybe just address the first of those, the bottom-up build-up of public policy. Remco, next slide, please. I think one of the things often when we're looking at the climate agenda is that we can, particularly following Copenhagen, get the impression that there's no global deal and that really nothing is going on. I think this slide neatly encapsulates the substantial build-up of initiatives, and this is really just looking at the carbon and clean energy-related initiatives around the world to deliver low carbon outcomes. We have now the majority of global emissions, over 80%, covered by policies, some of them voluntary, some of them legally binding, and in many ways we see action, particularly in emerging economies, moving faster than the industrialized world. So the climate regulation is already impacting profitability across sectors and regions, and this build-up at the national level and also at the local level at cities is becoming more and more material. So I think the notion that the climate agenda is off the boil would be mistaken. So that's reason number one. Reason number two is the intensification which we can see in terms of climate impacts. Material here from Munich Re, who've been tracking the implications of climate change for their businesses, insurers, for the last 20 years, showing the steady rise in natural catastrophes, particularly meteorological events. As you can see, the red line, the geophysical events, the earthquakes, tsunamis, fairly steady through the last few decades, whereas the meteorological and hydrological events are really quite substantial upward curve. We know the governments are now targeting 2015 for the agreement of the next global deal. There's negotiations underway. And importantly, I think it is interesting that if we look around the world, particularly in the United States, where we haven't been able to get comprehensive federal climate and energy policy, the public perceptions are changing here, and I think it's interesting to see how I think the droughts of this year have led to a sense that climate change is happening. Maybe Julie can comment on that. But I think the public perceptions of the importance of climate change, plus also clean energy and environmental action more generally, are still important. So then we look at the issue of business performance, and I think as investment professionals, this is an area where we are intimately involved, whether we're as investment analysts or portfolio managers or pension fund trustees, really trying to understand the intricacies of the implications of the shift to a low-carbon world and what that means for the performance of our portfolios, whether equities or fixed income or real estate and so on. And these are some fairly compelling results that have come through the steady build-up of data from the Carbon Disclosure Project, and maybe Nigel might be able to elaborate a little bit more on this. But I think if we look at the returns for these companies in the Carbon Disclosure Leadership Index and the Carbon Performance Index, from 2005 to 2011, a very interesting outperformance from these two indices, one looking at disclosure, one looking at performance, compared with the Global 500 as a benchmark. There may be many other factors that might be influencing that, sectoral factors, geographical factors, but there's something certainly substantive that needs to be examined in terms of the management of climate risks appears to be leading to a much stronger portfolio in terms of outperformance on the equities side. Turning maybe more to this issue of the agenda we're facing really today about measuring and reporting climate performance from the investor side, the fourth driver, Remco, is this issue of the growing expectations of investor transparency, which I think has been building up in the last few years. We now have a fairly well-established system of corporate disclosure, largely driven through the machine that is the Carbon Disclosure Project. I think there's increasing recognition that also investor disclosure closes the loop of corporate reporting. It shows back to corporations how investors are using that data. And I think in many regards, investor transparency has been identified as the next frontier in terms of investor action on climate change by a number of civil society initiatives. So in terms of the reputational expectations that civil society has of the investment community, I think the question of transparency is rising rapidly up the agenda. And maybe a fifth driver, just to complete the why we should be looking at this with increased attention now in 2012, is this growing spread of mandatory greenhouse gas disclosure requirements and broader ESG and sustainability requirements. High on the agenda this year at Rio Plus 20, again, investment-led initiatives to get a global system for report or explain. A number of countries listed here, from Australia through to the US, have some form of disclosure requirements, either through environmental policy or through stock exchange requirements. Most of these schemes, as we know, do target companies, but I think there are some nascent regulatory efforts to target investors and financial intermediaries. Again, at the moment, largely in Europe, in France through the Grenelle program, and also through the European Commission's proposals to require performance reporting on ESG from retail funds. So a set of sort of 5 strategic reasons why we also need to be thinking more about greenhouse gas implications for our funds and our portfolios, but also why we need to be thinking more about the measurement disclosure of greenhouse gas risk and intensity. So how can we do this? This is the project that Unify has been working on with its partners over the last year or so, commissioned some external research. And I think there are sort of 3 areas that we've been really looking at. How investors can understand and measure carbon risk exposure, then looking at one particular tool, carbon footprinting analysis at the company portfolio level, and then thinking about how risk exposure can be managed by reducing the carbon footprint of investments' portfolios. So let's touch on these in turn. So firstly, in terms of understanding and measuring carbon risk exposure, what we did in the research was to look at how investors are really looking at these different levels of carbon risk analysis. First, obviously, we need to distinguish between the external risk factors, those coming from policy, those coming from markets, from technological change, and also the changing social and consumer expectations of companies and investors. Then, obviously, we need to look at the positioning of our specific portfolios and critically look at that across a number of dimensions. I think we're very familiar now. We're looking at the operational dimensions, perhaps what we could call Scope 1 and Scope 2, but particularly supply chain implications are important for many companies and more important than their operational emissions exposure, and for many companies, for example, in the auto sector, it's the product emissions that really have the greatest risk and opportunity. And one issue, as we know, that has certainly caught the attention of many people around the world is the carbon risk associated with reserves, particularly in the fossil fuel sector, and the potential for stranded assets there. We have improved data, as we know, through initiatives such as the Carbon Disclosure Project, so we can start doing a lot of quantitative analysis, but I think we're still recognizing that we still need qualitative tools to look at the carbon risk exposure of particular funds. So one of the tools that has been used by a number of funds is to look at carbon footprinting, particularly focusing on Scope 1 and Scope 2 emissions, direct emissions from company facilities, and also bought-in energy in particular. These have been published by a number of investors. I think one of the concerns that has been expressed in the research work we've done is a concern about the data depth and whether the data can be relied on to provide publicly available carbon footprints, and similarly a concern about the data quality, and that has been constraining the rollout of these carbon footprint tools. I think one positive piece of lessons that we had from the project was that these footprinting tools can provide a platform for client communications, from pension funds to their beneficiaries, from fund managers to their investors, and also provide the baseline from which carbon efficiency improvements can be made. So just as investors are now calling on their companies through initiatives such as the Carbon Action Programme to set targets. Similarly, funds and portfolio investors themselves can also set targets once baselines have been established. So where next? So that's a brief review, hopefully setting up the presentations we're going to hear from our 4 expert speakers, hoping whetting your appetite for this issue. Where next? My sense really is that if the last decade really has been about the corporate response and corporate disclosure around climate performance and risk, the next decade is going to be very much around the investor response, building on the corporate level and really understanding and responding and being more transparent to a whole series of external stakeholders. Building on the carbon footprinting and thinking about scope 3 reporting as financial institutions. I think there's a need and potentially an opportunity for financial institutions to anticipate rising societal regulatory requirements with an investor-driven approach. And there's also a need to collaborate to develop common data methodologies so that this measurement and disclosure imperative is delivered at least cost for ourselves and our clients. And then obviously the important thing out of all of this is to use this carbon performance data to inform our engagement as stewards of assets with companies, and also in terms of asset allocation decisions, to use carbon performance data to influence asset allocation decisions between stocks, sectors, and also different asset classes. So hopefully that gives you a good background. I'd like now to go to some brief opening comments from our 4 expert speakers, starting with Nigel Topping from the Carbon Disclosure Project. Nigel, over to you.
Thanks, Nick. Thanks for setting the context so well. I just thought I'd build on that by explaining a little bit about the journey that we've experienced in the last 13 years since we were founded to getting to where we are now, and then some reflections on the way forward. And I think in reflecting on the journey, it's worth reminding ourselves that although in many ways what we're talking about today is the vast amount of work still to do, that collectively we've come a long way in the last 10 years. In September, there were over 6 million hits on Bloomberg terminals for GHG data. 5 years ago, it was 0 because there was no data available. We hadn't started partnering and providing data. And 5 years before that, there was basically no data anywhere on climate change issues affecting major listed companies. 2003 was the first year which CDP ran its disclosure process. We only engaged with the Global 500. We were only supported by 35 institutional investors with $4.5 trillion of assets under management. This year, more than 4,000 companies, and it's still rising, have already disclosed. There's 655 investors and $78 trillion of assets supporting that. We'll do the analysis when the disclosure is complete this year, but last year more than 56% of global market cap was disclosing through CDP to the world's institutional investors. So in many ways we've come a long way. How have we done that? I think largely by keeping it simple and by being attentive. First of all, I think we paid heed to some very wise advice we had in the first place. Start global and expand local, the kind of opposite of the way most initiatives grow. Secondly, we provide a lot of support to companies and a lot of detailed guidance, recognizing that for companies in whatever sector, this has been a massively steep learning curve. And I think thirdly, creating some very credible rankings has been a very powerful way of getting many companies to involve. In fact, Sustainability have just published their recent the Raters report, and CDP's rankings, which you mentioned earlier, come out as the most credible by quite some way above FTSE4Good and DJSI in second and third place. The way in which we've got investors involved, I think, is in some ways, again, very simple. All we've asked investors to do, and I think many of you will know, but all we actually ask investors to do to become signatories to CDP is literally that they sign a letter requesting information from the listed companies that we engage with. But we have also continually engaged very proactively with the investor community. Of course, some of them are very active and engaged, and some of them are not, on how to develop the information requests. I think a point which you alluded to, Nick, is the absolute importance of developing both quantitative and qualitative data for two reasons. One, quantitative data, although on the face of it is much easier to deal with, never tells the whole story. The contextual issues around risks, opportunities, and strategy and governance are always very important. And secondly, the quantitative data, although it continues to get better, in the very early days is always problematic. It takes some time before companies master the art of gathering and calculating and publishing reliable emissions data. I think that next, just to touch briefly on how we encourage investors to use, the first thing I would say, and this is something, a comment which David Pitt-Watson from Hermes made at Rio when asked this question, is that just by asking for information, investors are already acting. And just by asking for information, company executives are required to respond and to demonstrate their stewardship of capital in a way which we know leads to change within corporations. So what gets disclosed gets managed, so to speak. The second way we encourage investors to use is just by making the data as massively available as possible via Bloomberg, via Thomson Reuters, Truecost, Iris, via more and more people using it in indices such as FTSE or Nedbank in South Africa, or our own rankings. And you alluded to some of the very interesting correlations, although we don't claim causality, but very interesting correlations between high performers in our rankings and financial performance over time. Certainly, will bear more research to try and understand what's going on there. I think also, by making sure we collaborate wherever possible. I mean, particularly strong collaboration with UNPRI, and I think also working more and more with regulators. We see, CDP having gone from being really purely voluntary to being quasi-regulatory, with 96% of the FTSE 100 disclosing, for example. And now we know in the UK, for example, the UK government mandating and their regulatory impact assessment, which they're required to do, was a slam dunk, because they were able to say that 96% of companies are already doing much more by disclosing to investors via CDP than we will require them as the government. So business can't say that this is going to be overly burdensome. I think in terms of what's next for disclosure, there's I'd say three areas that I'd point to. The first one is as we all investors, companies, regulators learn how interconnected everything is, and the energy, water, food nexus perhaps best sums it up. Then there will be more and more requirement for more holistic disclosure. So we've already extended into water. We're taking over the Global Canopy Program's disclosure work on forest commodities next year, and we're very involved in the Integrated Reporting Committee. I think the second is moving from disclosure to action. Many of you will know we're in the second year of working with a pioneering group of investors, being more proactive in asking companies to demonstrate that they are setting aggressive targets and that they are investing on the left-hand side of the marginal abatement cost curve. We're just finalising the results from this year. The first year, I think 35 Global 500 companies who were specifically asked and engaged with on setting targets did so, and this year I think it's going to increase by a significantly higher number, although we do know that the level of ambition in company targets is not sufficient by a long way to meet the reductions that the science demands of us. So setting targets is the first step, making sure they're ambitious enough is the second step. And finally, I'd say, just back to the topic of this conversation, the learning curve in almost every sector goes from direct operations to extended value chain. That means that a lot of the work that we're doing increasingly at a sector level is looking upstream and downstream, and perhaps nowhere more important than in financial services, where no matter how much you green your offices, it's really what you're doing with your investment and loan dollar that matters. So I think we're very excited about the work that the Greenhouse Gas Protocol team are doing now on the Scope 3 standard for financial services, and we see this as a really important area for the financial services sector to not just be asking for disclosure, but meeting the same levels of transparency that they expect of others. That's it from me, Nick.
Can you hear us? I think
Sorry,
probably.
I was mute, sorry. Julie, if I could turn to you. Can you hear me now, Remco?
Yes, yes.
Yes, sorry. You've been part of the project team at UNIPFI to look at this agenda. It'd be great to get your perspectives on where we got to and where we need to go.
Then you shall have them. Can you hear me okay?
Yes, Julie.
Okay, thank you. So I'm going to talk about three things this morning. The first is how helpful CDP has been, which is perfect, just following on to Nigel's excellent presentation, and it's really good to hear and to know that CDP isn't kind of resting on its laurels, that in fact it does see additional frontiers that need to be conquered. So that's really good to know. So CDP has been extremely helpful to investors. There's probably nothing that's, in terms of a disclosure initiative, that's moved the needle as much as CDP has in its decade or so of existence. We still do rely mainly on voluntary disclosure. In some markets you can get mandatory disclosure, as Nick pointed out, but an awful lot of them you still do rely on mandatory disclosure to understand how well companies are positioned to understand and manage carbon and climate risks, that is, regulatory and physical risks. And there is, I think, no question that CDP has transformed the field of play in voluntary disclosure. And in some cases, in particular in the United States, that kind of voluntary action is almost becoming a necessary precursor to regulatory action, as it was very much demonstrated when the EPA adopted its requirement that emitters of more than 25,000 tons of carbon disclose what their emissions are, and that was last year. It's been less helpful, though, CDP, in aiding our understanding of physical risk. That's not its fault. It is a corollary of the fact that in order to understand physical risk, you have to have at least a nodding acquaintance with the status of climate modeling. And while scraping that acquaintance isn't exactly rocket surgery, the modeling itself can be quite complex, and understanding it at a granular level is beyond an awful lot of companies or investors, even if they had access to the models or to the sort of the granular level of the models. You can get that, but it can be very daunting to try to get there. What CDP has done is put the need to understand all the forms of climate-related risk on the scope, and it really has moved the needle, getting information specific to companies' understanding and management of the risks. It's another piece of the puzzle we need to use to understand how much we can trust anything the company says. So, for example, if a company gives a very good CDP response, yes, we understand that there is anthropogenic warming and we're responsible for some of it, and here's what we're doing to lower our emissions, and here's what we're doing on the opportunity side. And then meanwhile, it's lobbying heavily in the United States, for example, to prevent the passage of any regulatory measure dealing with greenhouse gas emissions. That gives us a little bit of insight into the company's willingness to tell the truth all the time and how much we can believe what it says. And thankfully, CDP is actually starting to tread this path, the path of, so is there any inconsistency with what the company is telling us and what it's telling regulators? There are a couple ways to make sense of the climate models, and there isn't really a clear signal as to what that makes the most sense. One is to look at the areas of consensus and figure out what that means. So if most of the models say the southwestern U.S. will become drier, then you need to go figure out who depends most on the availability of water in the southwestern U.S. and assess the risks accordingly. If you have a nuclear plant in Arizona or California, you really need to pay attention. Another possibility is to look at which outcomes present the most risk, either catastrophic or habitual. And in terms of catastrophe, nothing really beats sea level rise, but that's the most uncertain, or one of the most uncertain of all the UNFCCC's areas of prediction. And so it's, it can be quite difficult for investors to understand what sea level rise risk really means for a portfolio. The major frontier in terms of what investors need to do with CDP is to find a way to do more than just avoid unrecognized risks, but to create alpha. This is something that Deutsche Bank climate change advisors said in a report that came out a few months ago, where they looked at 54 different academic studies linking some form of ESG virtue to financial performance, and they said the evidence is clear that more sustainable companies actually do perform better. The challenge, it seems hard, is for portfolio managers to identify those companies in advance, and that is absolutely true. So what we need to do now with CDP data and climate information about companies as investors is not only avoid risks, but to find a way to capitalize on the opportunities that they present. Second thing I want to comment on briefly, a little bit more briefly, is the information disclosed to CDP used to inform investment decisions by your peers? That's a one-word answer, yes. And I can make it a several-word answer by saying yes if they have 3-digit IQs. I mean, you'd be really stupid to ignore any source of information. What do we need for more of our peers, or for everyone, to use this kind of data? And that's the hard part. Anyone who isn't using the sources of available data that are really good data on risks is leaving the proverbial $20 bill on the on the proverbial sidewalk. But what we really need in order to get it for any kind of portfolio management is information on both climate and carbon risk from all companies, large and small, regardless of domicile. And the only way to get that is through regulation. Or one of the only ways to get that is through regulation. It should be something like financial reporting, where it's considered potentially material for any company and thus becomes a regular and routine part of the reporting for all of them. There are still whole universes of stocks where this information is precious and scarce. If you're running an emerging market fund, it is difficult to really assess. There are going to be a few companies in your portfolio that may say something, but the majority of them won't. If you're running a small cap portfolio, same thing. So that's what investors really need, and it's probably about as far off as you can imagine, but it's something to try for. Finally, would fund managers be incentivized to more systematically consider climate change and opportunities if they were pressured to be more transparent about how they are addressing climate change? Yes, I do think so. The type of pressure is critical. So fund managers respond to their most important clients. We've seen that already. For some of them, that pressure from asset owners is the most effective. For others, and this would include my firm, for example, we don't have that many institutional clients, that many asset owner clients, and if we, lost them, it wouldn't, it'd be in 3 significant digits away from rounding error in terms of our assets. I know that's not true of everyone, so it is very important for asset owners to be transparent and for them to say that they really, not only that they value this, but to really make it part of their RFPs, make it part of the way that they assess their asset managers for their actively managed portfolios. Or for that matter, even in the passive portfolios, you can do this kind of thing passively as well as actively. But for asset managers who don't have a lot of institutional clients, the only pressures that really matter are those from investors, and that rarely happens. So if you're a mutual fund and you have 1,000 jillion, individual investors, they rarely have any capacity to mobilize to exert any pressure on you, or from regulators, and that's tough to achieve too. But the stock exchanges could really help out here by mandating some kind of disclosure on the part of listed companies. That will affect some asset managers because some of them are, in fact, publicly traded, and it will make asset managers aware of a new source of information from which they can try to create alpha. So that is my brief remarks, and I will pass the baton back to Nigel. Or sorry, to Nick.
Great, Julian. Thanks very much for introducing this new form of extremely hard task. I think you mentioned rocket surgery at one point, which sounds tough. Julian, if I could introduce you, Executive Director of Asset Owner Disclosure Project, very much focusing on this issue of disclosure from investors, building on what Nigel's been talking about the corporate side of things. Could you just give some opening thoughts about where you think we are and where we need to go?
Yeah, thanks, Nick. Will do. I'll just start by commenting on something that Julie said. Of course, for us, one of the key goals of the Asset Owners Disclosure Project is to get to 100% of CDP disclosure. So it's interesting that Nigel sort of talked about 56% of the listed market being under disclosure. But really, it's not just the regulators, of course, it's the owners of the companies that can take us all the way to 100%. How can we help drive the integration of climate change risks? Well, I think what's going on in the industry is that there's going to be a significant cultural shift. I sympathise with asset owners in many respects, because climate change is a unique portfolio challenge. It is long-term, high certainty, high impact, and that certainty comes from knowing the nature of the marginal cost curve if we're going to limit global warming to 2 degrees. And therefore, from a risks perspective, it really boils down to the chance, you think, that regulation will be implemented to keep us to 2 degrees, and the timing of that regulation. And I'll come back and talk about that in just a second, because that's absolutely key to, I think, what we're trying to get from the asset owners. AODP actually has 2 separate parts. We are generating an industry rating system, because I suppose unlike the funds management market and certainly the corporate markets, I don't think anyone could really claim that there's significant competition at the asset owner level. And so we started shamelessly copying the CDP model, I have to add. And indeed, from a disclosure perspective, our framework looks to mimic what CDP does. We ask asset owners to publicly release the information that they disclose to us, and we'll be using that to drive a ratings index, which we'll launch probably around Qatar at the end of the year. We think this is a difficult cultural thing for asset owners to do. It's not easy to get out of bed each morning as an organisation and say, I want to become more transparent. I just don't think it's human nature. But to encourage them along, we've spent the last 2 years rating the top 300 anyway. So there'll be a significant number of the large funds in our first index, which we release in December. We do this by looking at 5 separate categories. So we look at transparency, risk management, investment chain alignment. It still puzzles me when we go back to the 2008 crash that we were promised that incentives in the investment chain would be realigned with the time horizon of risk, and I think we're still waiting for that. So a key part, and indeed it was I think a focus of the Generation Sustainable Capitalism piece that was launched a while back, is aligning the incentives back to the long term. The second part is the civil society piece, which we actually launched in New York last Friday, and you'll find over the coming year that social media platform has, I think, all the big civil society groups joining it gradually and putting their members towards it. It's www.areyouthevitalfew.org for a quick plug. And really, this can only, I think, can be driven down the investment chain if members themselves of the asset owners, therefore the pension funds, but perhaps later in time, stakeholders and sovereign wealth funds too. But really, it's going to be up to the members to drive their funds to conduct change. Change is hard, so there's no point all this business strategy stuff, which is actually my background, all the stuff that the consulting world tells you about embracing change, I'm afraid just doesn't stick with me. It's hard. It's going to involve cultural and structural change at the asset owner level, and that means adopting a whole of fund approach to managing that change by asset owners. And we need to understand the barriers that are preventing them internally and externally. I think regulation has a piece to play in all of that. But essentially, it's going to be the drivers of pressure from members and civil society that we think will make a difference. I mean, ultimately, of course, this is in the asset owners' interests, because we all think climate change is a pretty devastating risk, and we want it managed. And of course, from a portfolio perspective, climate change is unique because 3 of the 4 methods to manage portfolio risk are unavailable. The asset owners can't avoid, they can't further diversify, and they can't insure climate risk. And really, the only way that they can manage it is by a hedging approach, a gradual increase in low-carbon asset investment to balance the very high levels of high-carbon assets that are in their portfolio. We think, and according to Deutsche, I think the number was 1.6% of a portfolio in low-carbon assets. I think there was a 2010 number. It's probably a bit higher by now. But when you add up stationary energy and fossil fuel extraction, mining, transportation, manufacturing, we think there's in excess of 55% of a portfolio exposed to climate risk and particularly regulatory risk. So hedging by that increase is really the focus in terms of solutions that we want the asset owners to disclose. The issue then for asset owners becomes, well, we don't see the sort of returns in the low carbon asset markets that we can get in the high carbon asset markets. And there is nothing like fossil fuels for stable returns. Ask the defined contribution pension holders in the UK what happened after Horizon once BP's share price halved, and they'll tell you it was felt in their pay packets. And so really this is about, well, how do we then rebalance that risk? If there is a debate to be had about sacrificing basis points of return over a 5 to 10 year period or a 0 to 5 year period that improves stability in the 10 to 15 or 10 to 20 year period, then let's have that debate. And let an asset owner whose members are on average 20 years away from retirement say we either want that extra stability in the 10 to 20 year period or we want to chase shorter term returns. And that's for us is the debate that is missing at the moment. And I think we can really help drive that. One last thing I'll say, because I know that we're running short of time, is at the detailed and corporate level, I think also we need the debate about how asset owners are going to drive the change via the fund management community. One of the things that, of course, is prevalent and very much relevant to the Carbon Tracker initiative is looking at the liabilities of the emissions that we are recording. And, of course, you're not incentivized, if you're a high emitter or a fossil fuel company, to put in a long-term carbon price assumption that affects your contingent liabilities, which in turn, of course, affects your balance sheet valuations. And so, really, asset owners are in the perfect position to say, well, we think on an expected value basis that there is perhaps 6 ways to get to the low-carbon economy, of which US politics is only one. You wouldn't think it when I was in New York last week. I think it's the only way to the low-carbon economy. But there are, of course, China's growth in its low-carbon strategy, renewable scheme convergence, innovation, physical impacts, and, of course, thematic asset reallocation themselves. Any one of those paths can help reprice effectively carbon in an intrinsic way. And asset owners can literally turn around to the fund managers and say, well, we think even if there's a 10% chance of any of those paths occurring, that we want our managers to use this in pricing those stocks. The trouble is, from a regulatory perspective, is I can't see a regulator waking up one morning and deciding to implement regulation that's going to crash a stock market. So actually, asset owners, you could argue, are perhaps the only community that have the real ability to conduct a smooth risk transition across a portfolio, because I can't see that, bearing in mind that emissions are caused by capital-intensive, often 25-year assets, it's not the policy that hurts the high emitters, it's the anticipation of the policy. And factoring it in, given that those high capital-intensive assets often take 2 to 5 years to be built, they need 25-year returns, and therefore it's the asset owners that can say, well, we think that that's what needs factoring into the balance sheets of those corporates now. And look, let's face it, there's going to be some volatility as a result of those thematic reallocations. It's going to take a long while for the low-carbon asset industries to catch up and replace within those sectors. And so I don't think we can do this without pain. The question is, do we want bad 10, 15, and 20-year pain, or is there a sacrifice in returns in order to get that stability? Back to you, Nick.
Thank you, Julian. And your last comments was only the asset owners can make the smooth risk transition across their portfolios. So neatly segues into Bill Hardnett, our last expert panelist. local government superannuation scheme in Australia. Bill, your thoughts about where you are as a large asset owner and how you're addressing this agenda. I think you have a presentation, Remco, if we're going to set up.
Yeah, g'day. Hi. Just getting my screen ready. And that should all be all good now, I hope.
We can see your screen, Bill.
Yep, okay. Well, thanks very much, everybody. My title here is, and I'll go through this pretty briefly, it's just a couple of slides, just some observations from an engaged asset owner. There are a couple of key words there. I think we are sometimes seen as being having gone a bit further down the road in terms of trying to evaluate carbon risk from an asset owner perspective, and so we are engaged, but these are only just still pretty preliminary observations, and the sort of complexities that Julian says here shows that we've got an incredibly long way to go. Local government super, but it's a journey we're enjoying doing. We're a $6 billion asset owner based in Australia. We'd have over $3.4 billion worth of that in strategies that are specifically related to responsible investment, climate change, across at least 5 asset classes, and we've been doing it for several years, and it's given us good results from both an investment and a sustainability perspective. So they are not necessarily mutually exclusive. So I wanted to touch on, if I can, a couple of things, and that is why we have actually gone down this route. And firstly, well, there's twofolds to this, and that's firstly, we see it as a risk issue. Many years ago, the board, and I've got a very engaged board on this, and I'm very lucky that I do as being a practitioner in this area, but there is an acceptance, and not a belief, but an acceptance from the board of LGS of the science behind climate change, and I think that's an important first step for all super funds and asset owners to look at. We're not about to trash the scientific method that underpins most of the industries and sectors in which we invest, just because climate change science based on scientific methodology is showing that there is an issue to be concerned about, there is warming happening, and that mankind is, and its activities is the primarily cause of it. You can argue more about what the future projections are, but they're pretty scary, most of them, and you can certainly argue and debate around what is the proper policy response, but we find it very hard to not accept the science behind climate change. And indeed, when you do get to that level of acceptance, it's very difficult not to come to the conclusion, I think, that we have, that climate change has to be viewed as a major long-term investment risk. And that being the case, when you see a risk in your portfolio, you've just got to try and monitor and mitigate the risks and you know, capitalize upon the opportunities as well. And as the other speakers have been talking about, climate risk is multifaceted, and a term that I brought up, made up multi-temporal. It sort of comes at different times and in different intensities in different sectors. The risks are dynamic, cross-regulatory, physical impact, changing demands in technology and stranded assets. So this is where it segues nicely into the area of the asset owner, because and why it's so crucial, and why I think you know, I've been a big fan of CDP and a lot of the initiatives now, but a lot of the focus is too much on the asset manager. You know, I mean, there's a chicken and egg story here, but it's the asset owner who's the long-term investor. We are the long-term holder of assets. I have external managers who might say one company is a bad climate risk and get rid of it, but then I have 4 or 5 other managers who will hold that same asset for entirely different reasons, and my portfolio doesn't look any different. So I'm a long-term holder of assets, and I'm meant to have a long-term perspective for my members' retirement savings. I'm future-looking, and I'm a universal owner. I don't escape negative externalities. And so this area of externalities, and then also what I've written here around materiality and principle and agency alignment, I think gets pretty important. Materiality, again, if we're looking just at the asset manager or the stockbroker, might be looking at something like the imposition of a carbon tax on say, a coal mining company. Now, generally, because their Scope 1 emissions aren't that great, it's not usually that huge an impact. But when I look at my portfolios and see how many coal companies or suppliers or Scope 2, Scope 3 down the line that I have, the materiality is much more significant. So there's a misalignment there between principal and agency, which I think is something that is an issue for the financial services industry more generally at the moment. Second area that I'd say why we're doing that is it's member alignment. We see this as being consistent with our fiduciary obligations. Our members are in local government. They're very aligned in sustainability issues. We see it as a license to operate and ability to innovate and differentiate our offerings as a super fund compared to others, so that we keep on going. So how to go about it? Look, I would suggest that you can review science yourself in your organisation at the senior executive and board levels. I'm sorry these are clicking up so slowly. And then, if you do decide to get serious about the area, establish good governance and management structures, commit, resources. I personally am a specialist in this area, but, I report directly into my CIO and my CEO. I get grilled by my investment committee every single meeting on every single investment that we do. If you can do that, it is successful if you commit. From here, develop your climate policies, your ESG policies, but make sure they're referenced to, the main investment policies that you have, your due diligence policies, your risk management statements. Please focus on the areas of highest risks and opportunities, which is your investment portfolio. Philanthropic activities are very nice, but really let's cut to the chase. If we continue not to do that, we will really face a license to operate issues. There are many tools, you've touched on it, about footprint and risk analysis. We've been doing that. But again, as an asset owner being long-term and looking at things around asset allocation, there are thematic funds that you can allocate to. We've done this in private equity and listed equity in government bonds that, if not a risk, some sort of response, or a hedge, a hedge, then there are some sort of response to climate change issues. You can demand climate change risk integration in your investments from your managers. Negative screens can be a great one. As can be in listed equities. I mean, in the ASX that I look at closely, everything's carbon intensive, and I've got to have exposure to the sector, so I've got to look at good governance of my companies. So engagement companies and indeed voting, I think, is a very worthwhile tool that I think we can use to demonstrate to companies and managers that we're very serious about climate risk in portfolios. So, there's a lot of, as I said, this is just observations. We're engaged. I think it really comes down to attitude. Julian is right. It's not easy, but it's, it's try, embrace. There's no real disgrace. There's a lot of unknowns, models to be learnt and hedges to be developed. But with transparency and disclosure and interaction, I think we can do these things. I might leave it just there.
That's great, Bill. A new meaning to the whistle-stop tour. I think that was fantastic in terms of the depth, including the multi-temporal perspective you mentioned. We have, I think, 4 minutes by my clock, or maybe 3. So we've got very little time, unfortunately, for you 80 people on the line. I've got a couple of questions, which I'm just going to read out very quickly, and then I think we're going to have to give some very quick answers from the panelists. Firstly, disclosure may make a difference if data is used in business and investment decisions. How can a portfolio manager be supported in understanding how particular stocks is exposed to climate risk? One point I would argue that a company's own carbon footprint is only loosely related to company's exposure. Carbon footprint disclosure might be a signal and helpful in assessing regulatory risk. Is it really a major factor? So that's a good question there. And then the fund management community is important from the commercial point of view. Build it and they will come. Is it not already? Is there not already all the low carbon and low footprint investment integrated or branding products in the supply? but the demand from the asset owners is missing. So that's maybe a good one to end. Is the demand for this strategic approach, which we've outlined, is that missing? Who wants to really finish this off? We've got 2 minutes, so I think 30 seconds from each. If I start with you again, Nigel, any sort of reflections on what we've heard?
Yeah, just those points. I think to the first point, I think there is a need for more sort of sophisticated investor education, and as some of you know, Mark Fox from Goldman Sachs Sustain recently joined CDP's New York team, so he'll be looking at launching some series of investor education pieces shortly. Of course, it's true that footprint is not enough. It very much depends on sector. I think as you and I and others have said, Nick, it's about overall portfolio risk, which involves a more nuanced understanding by sector. And yes, there's a need for more demand. A lot of that, of course, is hampered by the fact that there's still so much policy uncertainty and so little pricing on carbon.
Mm-hmm. Great. That's very brief. Julie, your reflections?
Yeah, investor education is incredibly important. I'm glad CDP is stepping up to the plate. I think even more to the point, I think trustee education is really needed. The most conservative sort of, what do I want to call it, modern portfolio theory slavish followers are among the trustees of many public pension plans and a lot of private institutional investors like endowments and universities. And I think there is where you really need to get in and educate people that, you know, for the most part, no asset owner, and despite what we all think, very few asset owners truly are universal owners. There is some scope for asset management. When there is that scope, or even if you are, you know, primarily indexed, there is some scope for, you know, you're not going to actually own the entire market. Everybody limits their portfolio somehow. Even if it's by financial criteria, there are ways to make money, and that is just one of those big things we have to drive to the heart of the trustee vampire.
Julian, any reflections on what you've heard?
Yeah, the liabilities of a high emitter, I think, are far more relevant to its carbon price projections, perhaps even than its emissions footprint. And one of the big issues we've all got is that, thanks to the accounting standards, a company in the absence of a 20-year carbon derivative market can essentially make its own assumptions. Now, we put a resolution to the Woodside AGM after the BP tar sands resolution in 2010, which was on the same issue. The issue is not about companies saying, well, I'm in a regulated market and the carbon price is €7 a tonne at the moment. The issue is, how do asset owners drive better use of carbon price assumptions in order to better ascertain the liabilities over a longer period of time? And I think we've got to try and create some consistency of view amongst the asset owners that can get driven downwards. And I think it's a big issue for the Integrated Reporting Council as well, because IASB 136, that impairment of assets, unfortunately isn't trapping companies who can create optimistic carbon price assumptions and raise capital in the markets to continually explore fossil fuels, which they are unlikely to be able to be burnt.
So once again, Bill, it comes back to the asset owners. And concluding thoughts on you, what you've heard today, and where you want to go next?
Yeah, well, you know, I mean, I certainly, well, I'd have to disagree. You know, we are, as I said, as a universal owner, as an asset owner, or as close to it as we can be. This whole area of, and this is why, you know, again, the focus has to be back on the asset owner, and a lot of, you know, the Asset Owner Disclosure Project does this. This focus on portfolio climate risk certainly introduces some tough questions with few readily available answers on, you know, areas that are fairly emerging and uncertain climate risks. And, you know, traditionally, due to conservative nature of my industry, it's probably safe to ignore these sorts of things. But I can't help but think that really, what were the mining and oil and gas companies and other, you know, big problem companies, if you want, thinking, you know, 15, 20 years ago when the CDP started coming around, or other ESG firms started coming out and asking about sustainability in their business. I can't help but think that the issues that they were faced at were much more significant to their business model than what we are dealing with here, and that it is not impossible for us to to deal and to cope with these matters. And, you know, we as asset owners do have stakeholders, and things such as the ODP and about a few are just going to magnify this. And getting back to these mining and oil and gas companies as examples, the most successful and resilient ones are those that responded meaningfully and transparently to these sort of changing industry dynamics and turn them to their advantage. And certainly there's so many examples of companies falling by the wayside who don't do it. And I think, you know, it have to be as an extension, the same thing will happen to our industry too.
Great. I think that's a very good place to end. Particularly, I think what we're all looking for now is resilient returns in a very, very volatile economic and also environmental situation. Thanks to everybody on the line for joining. Sorry we didn't have more time for questions. Thanks to our expert speakers, Julian, Julie, Bill, and Nigel, sorry. And watch this space for the latest publication from Unipify, which will be going into these details in more detail. Thanks to everyone. Remco, any final comments?
No, thank you. Thank you, Nick, for taking us through the webinar. And again, just stay tuned on the Unipify website for our publication on this issue.
Thanks, everyone.
Goodbye.
Cheers.